All right, well, despite two encouraging inflation reports this week, our next guest warns a disappointing batch of consumer data is ahead. Mark Zandi is the chief economist at Moody's Analytics. Mark, great to speak with you again. We're getting a lot of housing data next week. As Julie had just mentioned, housing is a very sticky part of inflation that doesn't go down so easily as easily as goods prices. And so how do you assess the consumer right now?
Good. Hanging in there, doing their part. They're not spending with abandon, but they're spending at a pace that's consistent with kind of pre-pandemic spending rates. They're shifting their spending, though, and that's why the numbers we might get next week on retail are going to look soft because people are not buying stuff, which is what they were buying during the teeth of the pandemic when we were all sheltering in place. And now they're out traveling and going to ball games and restaurants. So they're just shifting their spending. So, depending on which part of the retail elephant you touch, you're going to get a different perspective. But if you take a look at the elephant, it's okay. It's fine. It's enough to keep the economy moving forward.
And the economy is 73% driven by people effectively buying things, and I get it. And I understand the data lately has been more encouraging. I think people feel a little more optimistic. But, winter's going to be here before you know it. Energy prices, I think, will continue to soar. Despite the fact that wage growth is there, people are still losing with an 8.5% inflation print. Does the consumer get scared in the fall, and are we just sort of whistling past the graveyard, as Danny Moses said on Tuesday night?
Well, if inflation stays where it is, it's 8.5% CPI inflation through July. If it stays there, we got a problem because you're right. Wages are rising 5-6% at most. So that means real wages after inflation is declining. It's cutting into people's purchasing power. Now they can manage that for a while because they have a lot of extra savings they built up during the pandemic because they were sheltering in place and not spending or got a lot of government support. So that helps tide them over, but they can't do that forever. So we do need to see inflation moderate. And that's why these inflation statistics we got on Wednesday and today are really very encouraging because they signal that we've seen a peak in inflation and inflation's headed in the right direction. But it has to continue to moderate, or otherwise, you're right. By Christmas, we're going to have a problem.
Hey, Mark, it's Jeff Mills. Quick question just relative to sort of this good news is bad news scenario. How do you view what's going on in the labor market? Obviously, good news kind of underpins some of the fundamentals of the economy. But then to your point about inflation, it may embolden the Fed, maybe makes them think they haven't done enough. So how do you square all of that in terms of the impact on the economy and then obviously the markets?
Well, I'm more of a good news kind of guy. I like jobs and creating jobs. And so that's really important. And the strong job numbers we got in July just show you how resilient the economy is and that it can take a lot. I mean, the pandemic, the Russian invasion, these are massive supply shocks. It's amazing our economy is still standing after suffering these two shocks. And the labor market is testimonial to that. Now, job growth needs to slow. Unemployment is 3.5%. We can't see that go any lower. Otherwise, wage and price pressures are going to develop, and the Fed's going to have to respond to that. But I think they'll get their way. And this coming week, we'll see the reason why. We'll see the softer retail numbers, and most importantly, we'll see those weaker housing statistics. That's the most rate-sensitive sector of the economy, and that's got to lead the slowdown. And I think we'll get a sense of that next week.
Mark, great to see you. Thank you. Mark Zandi of Moody's.
I love Mark's work. I've followed him a long time. When I hear statements, though, like it's amazing how resilient this economy is given those supply shocks, I'm looking at a chart right here of the Fed balance sheet that prior to the pandemic was below $4 trillion, and here we are just under $9 trillion. I don't think that is the framework for a really resilient, strong economy. I see an economy in 2019 that was actually already weakening, right? And we already had that inverted yield curve back then, if you think about it. So to me, and listen, he's an economist. He's forgotten more about economics than I'll ever know, but I don't think that translates particularly well to risk assets if you think about what it took to be this resilient.
Right. Julie, you're nodding in agreement with Dan.
No, I completely agree. I mean, it's great for us to talk about the resilient consumer, and the consumer has been an absolute beast. But to forget how much stimulus has been pumped into this economy, we're not looking at any kind of real data. The shadow of all this stimulus coursing through the system doesn't give us a good sense of the underlying strength and health. If you talk to the average person, they don't think that things are amazing. They're tired. So I just think, like, yes, the consumer is resilient, and I think that's just true about the U.S. consumer generally. But I'm pretty negative when you consider just the wave of liquidity that we've had.
There's also this pull forward that had happened, right, in terms of spending on all sorts of things, in terms of spending on services now, in terms of spending on travel. I know a lot of people have been going on vacation this summer. I don't know if they're going to do the same level of travel come the fall, come the winter, come next spring even, Jeff.
Yeah, and I think that's what we have to start paying really close attention to. And looking at the labor market, looking at initial unemployment claims kind of moving in the wrong direction. So you have this spend redirect into services, but how sustainable is that? I mean, you're already starting to see delinquency rates tick up, particularly in the subprime part of the market. So maybe that's a little bit of a canary in the coal mine. Banks starting to tighten lending standards a little bit. So you're starting to see the very beginnings of all of this, even though it hasn't been, completely evident in earnings calls and things of that nature. But I do think that that's coming. And just because consumers have healthier balance sheets today than they did in, say 2008, 2009, that was certainly the case in the 60s and 70s and even in the early 80s. And we had 5 recessions during that period. So I think we're in for some sort of negative credit cycle, even if it's not as severe as maybe what we've experienced recently.
And the pushback on the consumer balance sheet is credit card debt in this country is about to surpass a trillion with a T. First time ever. And I think 250,000 new credit cards have been opened since the spring. I mean, that's not, to me at least, that's not a particularly healthy sign.